Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, my name is Ravi Singh. I'm the Chief Investment Strategist at Standard Chartered Bank, India. We have just released our quarterly India market outlook titled Positioning for Volatility. In this edition, we discuss a key question: what is the impact of India's inclusion in global bond index? India had been on JP Morgan's index watch since 2021 for inclusion into Emerging Markets Government Bond Index, following the Indian government's substantive market reforms for aiding foreign portfolio investments, including the fully accessible route program instituted in 2020. After the 2023 Index Governance Review, JP Morgan announced in late September that India will be included in the Emerging Markets Global Diversified Government Bond Index and all relevant derivative benchmarks, including custom indices. Following the announcement, India is expected to reach the maximum weight of 10% in the GBI-EM Global Diversified Index, staggered over a 10-month period starting June 28, 2024 through March 31, 2025, through increments of 1% over the 10-month period. Currently, 23 Indian government bonds or IGBs with a combined notional value of USD 330 billion are index eligible, the criteria for which is that it should have a notional outstanding of at least USD 1 billion or equivalent and with at least 2.5 years remaining to maturity. Overall, we see this announcement as a medium-term positive for Indian fixed income market that has long struggled to attract foreign investor interest, as foreign investors currently own less than 2% of Indian government bonds, the lowest in emerging markets, despite being one of the largest liquid government bond market among the major emerging markets. We expect this development to have these following impacts. First, it is likely to have limited immediate impact on Indian government bond yields, given the long lead time for index-related inflows and the near-term headwinds, which includes the rise in global crude oil prices and higher US bond yields, which limit the appeal of Indian government bonds. Second, it could improve the medium-term demand outlook for Indian government bonds with a potential for USD 20 to 25 billion inflows by March of 2025, given that the AUM tracking the GBI Emerging Market Global Diversified Index stands at USD 200 to 250 billion. Third, it is expected to be positive for medium and long maturity bond yields as bulk of the eligible securities fall within the 5 to 14 years maturity profile. Fourth, this can lead to a significant diversification in the investor base, supporting lower borrowing costs, which would be healthy for the overall market. And finally, it is expected to be positive for India's external balances, supporting the INR stability in the medium term, a key consideration for offshore bond investments. That's it in this edition of the podcast. Do reach out to your relationship manager for a copy of our India Market Outlook, and thank you as always for listening. If you enjoyed this podcast, please like and subscribe.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.